All right, excellent. We are making great progress here. By now, you should be able to format Excel spreadsheets and make them look professional. Use Excel shortcuts so you can be 3 times faster than average users, and apply different mechanics and functions that allow you to use Excel effectively. We learned about financial modeling and its purpose, so we are almost there. The next step we need to make is to build a complete model from scratch. This exercise would allow us to do 2 things. First, you can apply, in practice, everything you've learned so far. Second, you will see how a complete financial model is built, step by step, with no steps skipped. Sounds great, right? Get excited and dive straight in as the exercise starts here. Our task is to create a P&L with the data we have here. This is an extraction containing 3 columns. The first one shows us the period when the amount was registered. The second one describes the financials that were booked in the company's system. And the third one contains the amount registered. Perfect. Let's copy this source sheet and move it to the right, as we want to keep it intact and use a duplicate sheet for all the changes we will make. That's a very good practice when you are working with source data. The first thing I noticed is that the date format is odd. Excel doesn't recognize these columns as dates. How do I know that? If I try to use the year function and point to one of these cells, I will get a value error. See? But that's okay. How can we solve this issue? The dots we see here aren't a typical date format, are they? Instead, much more often, we have seen the slash symbol used for dates. We need to substitute dot symbols with slash symbols for all rows. Find and replace will be helpful in this situation. I only have to select the whole column and then click Ctrl and H, which is the shortcut for find and replace. We said we would like to substitute dots with slash symbols, right? Okay, let's click Replace All. And immediately, Excel recognizes this is a date format. Now I can easily insert a new column to the right and use the year function to obtain the year when financials were booked. Perfect! We are off to a great start. See you in our next lesson. In this lesson, we will continue to work with the source sheet. As you can see, all financials are broken down by category. We can see revenues from supermarkets, discounters, grocery shops, and retail. The same goes for COGS. That's great if we want to analyze category profitability. But in our case, we want to build a model at a total company level. So all we need is a mapping that shows P&L categories: revenues, costs of goods sold, operating expenses, D&A, interest expenses, and taxes. Okay? So how are we going to do that? We can simply create a mapping column to the right. Select the top row of the table and add a filter. We can do this with the Alt, A, and T shortcut. Once we've done that, we can filter for each of the P&L items we have here. I will filter for revenue. And when the source data has been filtered, I only have to type revenue and paste for the entire column. Okay, great. So now I will remove the filter and will carry out the exact same operation for COGS. Please note that I am using the search functionality when filtering. It is convenient when working with larger datasets. All right, I'll paste COGS to the bottom. The exact same steps must be carried out for operating expenses, D&A, interest expenses, and taxes. Adding a mapping to your sheets can be very useful. This allows you to create categories assigned by you. You are not stuck with the original categories you found in the source data. This is a valuable tool, and I'm sure it will help you a great deal. All right, excellent. So, once we have carried out the mapping exercise, we will be ready to create an output P&L sheet and use the numbers we see here to fill its historical years. This is it for now. Thanks for watching. Right. Now that we have a mapping, we can create an output P&L sheet. I will create a new sheet by clicking on the tiny plus button down here. And we can use the macro we saved earlier to format the sheet professionally. In this exercise, we can apply many tools we saw earlier. This is awesome, as it will reinforce what you've already learned. I will simply click on the Developer tab and then on the Macros button, and run the formatting macro we have here. Great! Let's copy the entire mapping and use Paste Special Values to have it in this sheet. Okay, perfect. Now I can simply use the Remove Duplicates functionality to obtain a list of financials we will have in the P&L we are creating. Perfect. Given we are creating a P&L, we must add a few subtotal and total lines, right? If we subtract revenues from COGS, we obtain the firm's gross profit. That's why I'll add a gross profit row here. Gross profit minus operating expenses gives us EBITDA. EBITDA minus D&A is equal to EBIT. Once we subtract interest expenses from EBIT, we are left with EBT. Finally, EBT minus taxes is equal to net income. Okay, great. This is the P&L structure we'll use going forward. Let's add the periods for which we have historical data. I'll simply open the source sheet and copy the entire column containing year's data. Then I can paste values in the output P&L sheet and remove the duplicate values. Okay, so we have data for 2014, 2015, and 2016. Let's create a top row, which will indicate the unit of measurement of financials and the year they were registered. We will work with dollars in million, and I will indicate that here. Then I can simply copy and use Paste Special Transpose to paste the 3 years horizontally. Great, we are almost there. We have a pact that all output sheets will be formatted professionally, don't we? Right now, the P&L doesn't look too good, and we need to do something about that. We can use cell styles and format the P&L much faster. This is how it's done. I've pre-saved a header style. That's why I only have to select the header of the table and click on Header. The same can be done for general, subtotal, and total values. Super easy and efficient. And it can be even faster if you decide you want to use a shortcut. By pressing Alt, H, and J, you will access the Cell Styles menu, and then you can simply use the arrow keys to apply the cell style of your choosing. Awesome! Our output P&L table is almost ready. We only have to fill it in with numbers. We'll do that in our next lesson. Thanks for watching. So, we've created a P&L output sheet, and it looks amazing. In this video, we'll use an Excel function to populate the P&L table with the financials found in the source sheet. Let's open the source sheet. Here we have multiple rows providing information about revenues, COGS, OPEX, all of the firm's financials. In the year column, we've extracted the year these financials were registered. Therefore, we can use a SUMIFS function with two criteria. One of the criteria will be the type of P&L item observed, revenue, COGS, etc. And the other criterion will be the year the amount was registered. We'll sum the column indicating amounts. Right. Let's go to the P&L sheet and create the function. We will have plus SUMIFS. The range to be summed is column E, the amount registered. Okay? I shouldn't forget to anchor these references, as we'll paste this function to the right once it is ready. The first condition is the type of financials to be summed. I'll select the range of cells where we created a mapping and fix its references. The condition is cell B4, where we have revenues. I'll fix the column reference of the condition. Its row reference remains flexible when we paste downwards, but stands still when we paste to the right. The range of the second condition is the column containing years. Let's fix this reference too. Perfect. The criterion we'll use is here, each of the 3 years we see in the P&L. I'll fix the row reference only, as this would allow me to paste the function to the right and switch to 2015 and 2016. All right, the SUMIFS function is ready. We can easily paste it to the right. We can paste it downwards as well, but there is one thing we shouldn't forget. Besides revenues, the rest of the values in this table are costs and should have a negative sign. Okay. All right, that's much better. We created a P&L table summarizing historical figures. Back. Percentage variations are a useful tool that facilitates the understanding of the dynamics of a business. So in this lesson, we will add them to our spreadsheet. First, we'll add a blank column to separate the P&L data from percentage variations. We can reduce the size of the new column to 1.25 in the column width menu. Okay, let's copy the format of one of the columns of the P&L table and use Paste Special Formats to improve the formatting of these two columns. Once we've done that, we can insert the two new titles. The first column will contain percentage variations between 2014 and 2015. And the second column will have percentage variations between 2015 and 2016. We will have percentage values here, and that is why I'll select a percentage formatting for these cells. We're ready to calculate percentage variations. The formula is given by this year's value divided by the value observed the previous year minus 1. Okay? Let's copy the formula for all rows of the table. Excellent. We calculated percentage variations. Our next task is to use conditional formatting and highlight strong and weak variations. I'll select all percentage values we calculated. We can find conditional formatting in the Home tab. Once we've clicked on the button, we can choose from several options. In this exercise, we'll use the traffic light icons: red, amber, and green. I'll select the icon set, and as you can see, conditional formatting was applied to all cells where we've calculated percentage variations. One of the subtleties when working with conditional formatting is that we should always edit the rules determining the colors of these cells. Excel does it automatically for us. However, ideally, we should always be the ones deciding when values should be colored green, amber, or red. That's why I'll click on Manager Rules and choose to edit the current rule. The rule I'll choose is to have green for variations of 10% or more, to have amber for values that are between 0% and 10%, and to have red for all values that are below 0%. Let's click OK. After the adjustments we made, our P&L looks much better. Thank you for watching. So far, we created a great-looking output P&L sheet for historical figures. In addition, we calculated percentage variances and inserted conditional formatting. That's great. Starting from this lesson, we'll deal with the firm's balance sheet. Let's create a new sheet and name it Balance Sheet. I'll use the formatting macro to improve the layout of this sheet without wasting time. Great! 3 new sheets have been added to our Excel file. Each serves as a source for one of the 3 historical years: 2014, 2015, and 2016. The 3 sheets do not have uniform structure. For example, in the sheet for 2014, the amounts of balance sheet items are shown in column D, while the sheet for 2016 contains the amount in column E. We must be aware of this issue from the beginning. Very well, having said that, we can move forward. I'll hold the Control key and select all asset line items we see in the source sheet for 2016. Once I am ready, I'll copy these values and use the Paste Special Values command to paste them in the output sheet. Then I'll do the exact same thing for liabilities. Select all values by holding the Control key and pasting them in the output sheet with Paste Special. Great! Let's provide a clear indication that one of the groups is composed of assets and the other one is composed of liabilities. I'll simply write assets here and liabilities and equity below. Okay, we'll have to improve the sheet's formatting. The first thing I'll do is copy the header of the P&L table and paste it here. There's one issue that must be fixed, though. We should never show balance sheet values as if they illustrate the entire year. These are the values recorded at the end of the year. So I'll make sure all read December 2014, December 2015, and December 2016. Let's use cell styles to improve the layout of the rest of the table. These cells will be formatted with the so-called general cell style, while the 2 rows showing the sum of assets and liabilities and equity at the bottom will be formatted as totals. That's perfect. Okay. Last thing I would like to do here is add sum functions, summing assets and liabilities and equity. And at the bottom, we'll need a check, which will verify if the golden rule of accounting is satisfied. Assets must be equal to liabilities and equity. If the check shows a value that differs from 0, then that's an indication we haven't worked correctly. Now that we've created an output balance sheet that looks great, we can use one of the functions we learned earlier to fill it in with numbers available in the source sheets. However, we need to pause for a minute and reflect on which function is suitable for this task. First, we have multiple source sheets. We should also know that each one of these sheets has a slightly different format. The balance sheet items we would like to obtain for each year are shown as subtotals in all sheets, but their values are in different columns. What is the right way to build a lookup function when columns and rows change their place? I'm sure you remember index and match, do you? Index is the array of results, and it needs two inputs, a row and a column number. Match searches for a criterion, and when it finds it, gives its number within the range where it was looking. So what are we going to have if we use index match match here? Think of the range where index will operate as a table. Okay? The function needs two inputs to give us a specific cell of the table. It needs a row number and a column number. We can use the first match function for the rows of the table and the second match function for its columns. When match finds the lookup value, it will indicate its number, and we will have a row number. It is the same with the column number. Match will look for it, and when found, we will have its number. The intersection of the two is the cell of the table we are looking for. The main advantage of index match match is it allows for two flexible lookup values, and that's valuable in some situations. To apply the function in this case, we must delete the empty rows and columns in each of the source sheets. Once we've done that, we can start typing. As an array where index will operate, I'll select the entire sheet. Then we will have the two match functions inside. The first one uses, as a lookup value, balance sheet line items. I'll fix its column reference, given we will paste the function to the right later. And then, the second input that we must provide is the range where the function will look to find trade receivables. That'll be column A in the source sheet. When match finds trade receivables here, it will produce a number, and this number will be used by index as a row number. The third argument is 0, as usual. Okay. The second match function will show us the column value, so I'll type match. The lookup value will be 31st of December 2014, and the range where we will look will be the first row of the source table for 2014. Why the first row? Well, that's where we will have dates in all source sheets. Once we're done, we can press Enter and see the result of the function. It worked! That's awesome! Let's copy it for the rest of the rows below. If we've worked correctly, the balance sheet should balance. And it does. All right, let's copy the function to the right. Can you think of a reason it didn't function? Yes, precisely. It didn't function because the function looks at the source sheet for 2014. Let's use find and replace and substitute BS 2014 with BS 2015. Okay? It worked. The same thing must be done for 2016. I'll copy the function we created for 2014, and we will use find and replace to substitute BS 2014, and BS 2016. We only have to copy these cells to the bottom of the table and see that the balance sheet balances for 2015 and 2016. It does. That's awesome. This will do for now. Thanks for watching. At this point, we have a great-looking P&L and a beautiful balance sheet. Both sheets contain historical figures only, and it is time to build a forecast. Let's use the Grouping Columns tool and hide percentage variances we've calculated in these two columns. I only have to press Alt, Shift, and right arrow, and the columns are grouped. If I press here, I can hide the two columns. Most professionals prefer hiding columns by using this functionality, and not the actual hide command. The reason is that, at all times, we can easily see there are some hidden rows and columns. This is where we'll have our forecast. Let's make it clear by highlighting a cell above this area and labeling it Forecast. I'll extend the cell for 5 columns, as we will have 5 forecast years. Good. Let's copy the formatting of one of the columns of the P&L and use Paste Special Formats to have it across all 5 forecast columns. Okay, that's perfect. The years we will have in our forecast period are 2017, 2018, 2019, 2020, and 2021. In addition, I would like to copy the formulas of all subtotal and total lines, as these will be used here. Very good. One last detail in the structure of this sheet is that we must build a few scenarios below this table. Therefore, I will create a box that reads Scenarios, and will use gray as a fill color. Okay, perfect. We are ready to build forecast scenarios. I'll add 2 blank rows above the table. And we'll include a scenario switch box here. Let's use a distinctive color. I like this one. Okay, this is where we will choose the current scenario from. Let's add a border and emphasize this cell even more. Perfect. The 3 financials we will forecast here are revenues, COGS, and OPEX. D&A and interest expenses will be forecasted on separate sheets, where we will carry out detailed calculations. The driver we will use to forecast revenues is percentage revenue growth. There will be a best case, a base case, and a worst case scenario. In most cases, COGS and OPEX will be forecasted as a percentage of revenues. And there will be a best, base, and worst case scenario for them as well. Excellent. I'll use data validation to add the 3 scenarios in this cell. We should be able to choose from a best, base, and a worst case scenario. In our next video, we'll learn how to build dynamic scenarios and fill in the numbers in the P&L table according to the scenario selected. This will do for now. Thanks for watching. Hi, and welcome back. In this lesson, we'll concentrate on the forecast of the 3 items in the gray box: revenues, COGS, and OPEX. As usual, we'll build our hypotheses based on the numbers observed historically. We've already calculated historical growth in the 2 hidden columns, remember? So I will indicate that we don't need this area. Let's open the Format Cells menu and click on the Fill tab. This is where we can choose a pattern style that shows we are not using these cells. Perfect. Let's look at COGS. We will forecast it as a percentage of revenues. Therefore, I will divide COGS by revenues and will obtain the figures for 2014, 2015, and 2016. These are historical numbers, and they won't change for the three scenarios. I'll copy the function on the rows below. The same must be done for OPEX. We will have to divide OPEX in 2014 by revenues in 2014. All right, excellent. Given we are building a top-level forecast and we don't have inside information that allows a greater forecasting precision, we can build forecast scenarios around these values. So, revenues grew by 2.1% between 2014 and 2015, and by 1.9% between 2015 and 2016. We can assume an average growth rate of 2% in the base case scenario. Let's use 1% for the worst case scenario and 3% for the best case scenario. COGS varied between 48% and 45% in the three historical years. The firm improved its efficiency and reduced the weight of COGS. That's why we can hypothesize a COGS of 46% in the base case scenario, 45% in the best case scenario, and 47% in the worst case scenario. Historically, OPEX varied between 42 and 35% of revenues. Let's assign these values for the three cases. 35% for the optimistic case, 39% for the base case, and 41% for the worst case scenario. These are the values observed in the three scenarios. Let's color them in blue and indicate these are hard inputs based on our assumptions. Okay, now we have to come up with a mechanism that would allow us to switch the selected values whenever we use a different scenario. There are a few different ways to do that, and I would like to give you a few examples how this can be done. So, in this video, we'll use one combination of functions that would allow us to create a dynamic switch. And then in the next two videos, we will create the dynamic switch by using different function combinations. Here, we can use offset and match. Offset gives us a cell that is X number of rows and columns from a cell where we start. So, we will start in cell I-20. And going from here, I need to tell the function how many rows downwards it should look. How can I do that? Well, match will help me. The lookup value for match is the scenario selected. I'll fix its cell reference, and then the range where match will look is right here. The three scenario names. Match will find the selected scenario and will provide its number in this range, 1, 2, or 3. The column value for offset is 0. Given I fixed column references only, I can copy the function downwards and use it for COGS and OPEX as well. Once we've done that, we will be able to switch scenarios dynamically. See? Awesome! So, the combination of offset and match is one way to make forecast scenarios dynamic. We learned how to use plenty of functions, so now we can exercise some other combinations too. What about the choose function? It's very popular for scenario building. Let's see how it can be applied in our case. I will type choose. The first argument of the function is its index value, which is a number, 1, 2, 3, 4, etc. Then, the next few arguments we need are the scenarios, which are selected. So, for this cell, we want to select the 3 values below. Which is the function that would allow us to obtain a number based on the name of the scenario we've selected? Yes, we need the match function. The lookup value is up here. I will anchor its reference. And then the lookup array is here. Let's fix its column references. The third argument is 0 as usual. Perfect! Match will look at the selected scenario and then provide its number within the selected range of 3 cells. The number will be from 1 to 3, and that's exactly what choose needs. A number from 1 to 3 that helps it decide whether to select scenario 1, 2, or 3. This is how we can build dynamic models with choose and match. Thanks for watching. Right, so far we've seen 2 ways that would allow you to build dynamic models and create multiple scenarios. Would you be interested to see a third way? If that's the case, you've opened the right video. This is what we are going to do here. VLOOKUP can be combined with several other functions. A useful combination of VLOOKUP is the one with columns, which serves as a counter for the number of columns. Let's show how this can be applied in our example. The lookup value we'll need is the scenario we've selected. I'll anchor this cell reference. The lookup table where we will look is in the entire range from B to M. The function will look for lookup value, and whenever it finds it, it will give us a result from that row. The third input it needs is a column number. But I'm sure you'll agree this isn't a dynamic function, is it? If every time we use VLOOKUP we have to pause and count column numbers, so it would be very inefficient. This is where columns comes into play. Proficient users use columns every time they use VLOOKUP. The function works in a very straightforward way. I only have to select the part of the table we've arrived at, and Excel will count the number of columns in this range. Simple as that. If we fix cell references properly, the next time we paste the function, it will have 1 column more, given that I've fixed only the starting column reference. Easy, right? Let's use this function for the 2 items below. Perfect. As you can see, we've obtained the same result as the previous 2 videos. Dynamic scenarios. Great! Let's use selected case values to fill in the P&L lines we have above. Revenues in 2017 can be obtained by multiplying 2016 revenues by 1 plus forecasted revenue growth. The same is valid for 2018, 2019, 2020, and 2021. COGS will be given by revenues times projected percentage of revenues for that year. The same holds true for OPEX. And this gives us P&L figures at the EBITDA level. In our next lessons, we will go deeper and will forecast the firm's entire P&L, balance sheet, and cash flow. And the best part is this is a dynamic model that allows us to switch between scenarios in the blink of an eye. All right, we're doing great. Our P&L table is set up to work with different scenarios. That's perfect. In this video, I will create a forecast area in the output balance sheet, which will be similar to the one we created in the P&L sheet. I can simply copy one of the columns and use Paste Special formats to paste it 5 times here. At the top, we can add a highlighted cell, which will show this is the forecast period. Let's copy the sum functions for assets and liabilities and equity. Excellent. I'll insert a few blank rows below the table. Here we'll have several forecast drivers for the balance sheet items. And I would like to distinguish this area by coloring it gray. In addition, we can extend the check for the forecast period, given that assets must be equal to liabilities and equity. Okay, which are the drivers we can use to forecast balance sheet items? The supporting materials that come with this lesson explain this in more detail. Please look at them before continuing. If you have, or you already know how to do this, we can continue. Trade receivables, inventory, and trade payables will be modeled with the days technique, while other assets and other liabilities will grow as a percentage of revenues. There wouldn't be different scenarios for BS items, as they mirror the P&L development of the business, hence represent a reflection of the P&L scenario chosen. The days calculation indicates how many days are necessary for cash receivables, pay trade payables, or that an item leaves the warehouse of the firm. Days sales outstanding, DSO, days payable outstanding, DPO, and days inventory outstanding, DIO, are working capital components. DSO is a measure of the average number of days a company takes to collect revenue after a sale has been made. A low DSO number means a company needs fewer days to collect its accounts receivables. A high DSO number shows a firm is selling its product to customers on credit and taking longer to collect money. DPO is a company's average payable period. Days payable outstanding tells us how long it takes a company to pay its invoices from trade creditors, such as suppliers. DIO is a financial measure of a company's performance that shows investors how long it takes a company to turn its inventory into sales. Now that we've described DSO, DPO, and DIO, we are ready to calculate their values for the historical period. We see the math formulas for the calculation of days on the right. Starting with DSO, we need to divide the number of trade receivables by the revenues for that year and multiply by 360. And here is the DSO number for 2014. Let's copy it to the right. Similarly, DPO and DIO are calculated with the same formula, although revenues are replaced by COGS. I'll select the amount of DPO and divide it by the number of COGS in 2014. Let's fix the row reference of the COGS figure and multiply by 360. The result of the formula is negative. Since we are talking about days, it would be unnatural to have negative days. That is why I'll negate this number by putting a minus in front of the formula. Let's copy the same formula for DIO. We can do that because we fixed the row reference of COGS. This is how we calculate DSO, DPO, and DIO. Let's calculate the percentage of revenues of other assets and other liabilities in 2014. To do that, I'll divide both items by revenues. Fixing revenues row reference makes things easier. We've done a great job here. The next step will be to fill in the forecast period. Stay tuned. There are two possible ways to calculate the development of these items. We can either consider the average days observed throughout the historical period or the latest figure. Based on the numbers we have, I'll use the average. Let's apply the average function for each of these items. These are the values we'll expect to have in the future. We need to reverse the calculation we had before to obtain the actual figures for trade receivables, trade payables, and inventory during the forecast period. Multiplying the number of days by the amount of revenues for the year and dividing by 360 will give us the number of trade receivables. Then we can copy the same formula for the rest of the periods. We have the same thing for trade payables and inventory. Multiplying the number of days by the COGS figure for that year and dividing by 360 will result in the trade payables amount for 2017. As you probably noticed, we are fixing the row reference of cost of goods sold when calculating trade payables. This allows me to copy the formula for inventories directly. These are the projections for trade receivables, inventory, and trade payables. If we select a different scenario, the numbers will change too. Awesome. Let's look at other assets and other liabilities. We only have to multiply the percentage of revenues they will represent in 2017 by the forecasted revenues in that year. Easy, right? Let's make another assumption, shall we? We don't know whether the firm will have to raise or decrease its current amount of provisions. Here, it is best to hypothesize that provisions will remain flat throughout the entire forecast period. So, at this point, we've filled part of the balance sheet. What about the other items? PP&E, cash, financial liabilities, and equity. These items are more complicated. We'll build detailed forecast schedules for PP&E, financial liabilities, and equity. Once we've forecasted these lines, we can calculate the firm's cash flow, and we'll be able to fill in cash. As you can see, we're doing everything one step at a time, with no steps skipped. Have become one of your favorite Excel tools.